Hey guys, Sean here. If you're an investor, you most probably fall into one of these two camps: the stock market lover who swears by the S&P 500 and dollar cost averaging is your favorite word, or you're the gold bug who has been stacking physical coins and bars like it's going out of fashion. Now, I'm invested in the stock market and I hold quite a bit of gold as well because there is a time and place for both. They are part of the overall equation, and in this video, we are going to discuss why when you have both, you have a portfolio that's diversified and works extremely well in today's crazy economy of boom and bust cycles. Firstly, we need to understand that the stock market and the gold market are both wealth transfer machines. The aim of both is to transfer wealth from the masses to the few. It has always been this way for decades, and it's really no longer about really building wealth. That is a fallacy that we need to dispel here. There will be conditions when equities are the best way for wealth transfer, and other times when gold is the better option. Now, conventional wisdom states that the wise thing to do is to constantly invest dollar cost average into your positions and hold on for 30 years. Now, if you do that, yes, you will come out ahead, but you're leaving a lot of money on the table, and I want us to be more deliberate here. Take gold for example. Since 1971, since Nixon closed the gold window and destroyed the Bretton Woods Agreement, gold saw a dramatic rise from $40 an ounce to over $2,000 in March this year, and that's a 50 times increase. But there has been two periods in time where gold did absolutely nothing. That was back in 1982 to 2002, and from 2013 to 2019, we had a gap of around 20 years from the 80s and 6 years after gold peaked at 1900 when gold was moving sideways before the bull market happened again. But the stock market also isn't a magic pill for investing. After the dot-com bubble burst in 2000, it took 8 years for the S&P 500 to return to its previous level before it crashed again thanks to the '08 housing crisis. Then it took another 5 years for the stock market to reach the same level back in 2000. That's essentially a lost decade. 13 years of sideways dancing. That is why having both to balance your portfolio is the smarter move. They are not well correlated with each other, especially during periods of stress and crisis like what we have today. Just remember that during this stagflation crash, gold has fallen only around 2%, while the S&P was down 20% during the same period, and this shows a big disconnect between these two assets during a deflationary crisis. But before we dive in further, a quick mention of our sponsor today, Skillshare. Guys, the markets are imploding, everything is crashing, and this is the best time to invest in yourself and your own learning. Skillshare is an online learning community, and they have thousands of online classes that include stock investing and technical analysis. On this channel, we take a high-level view of the economy and we go macro, but when it comes to picking stocks or finding good entry points to buy or sell, you need a specific set of skills, and that is what I'm learning right now on Skillshare. I'm taking a class by Jimmy Nguyen called Technical Analysis Made Simple, the Power of Trend Lines, Support and Resistance, and I'm loving it. The class covers important concepts including drawing accurate trend lines, understanding trading breakouts, and how to correctly use moving averages. And thanks to Skillshare sponsoring this video, the first 1,000 people to use the link below will get a 1-month free trial of Skillshare. In this 1 month, you can take dozens of classes from investing to building a business. So join today and start learning, because the best ROI you can get is always investing in yourself. So alright, back to the video. Now I want to ask you a serious question. What drives the markets today? Now, you can say supply and demand, you can also say it's earnings and profits, and for individual stocks and commodities, that is true. Those are very important, but I would argue the real driver of the markets today, especially since 2000 onwards, is cheap money and credit, and that makes the Federal Reserve the master of the financial universe. Now, every time Jerome Powell makes an announcement, he can literally move the markets if he decides to hike or ease rates, and especially if the Fed decides to print trillions of dollars once again. And that is why so many people are obsessed with tracking with what the Fed does, myself included. And when we are analyzing which is the better assets, stocks or gold, we need to define the environment we are in. Are we in an environment where interest rates are low and money is cheap? Or are we in a situation today where interest rates are rising and it's getting more painful to borrow money? Because if you get this wrong, you might actually lump sum invest into a market that's about to fall, and that is very dangerous. Since 2008, we have been in a raging bull market in both the stock market and gold, and that's because the Fed has kept interest rates near zero for over 12 years. When you make the cost of borrowing dirt cheap and inject trillions of dollars to stimulate the economy, you create the ultimate environment for speculation you create a moral hazard. And that is what we had for the last decade or so, and that is why we saw new assets like Bitcoin go from $1 to over 60 grand within 10 years, and people burning hundreds of thousands of dollars for NFTs of digital looking apes and crypto punks. It doesn't make sense anymore because people are just blindly chasing returns. We are in a risk-on environment where all you had to do was to click a button and you probably would have made money a month later, but all that is changing today. We are now in a risk-off environment with the Fed desperately hiking rates and pulling money out of the system to fight inflation. They are trying to crush demand, and that is why we are having a massive sell-off across the board, especially in stocks. But if you had some gold, it would have cushioned your fall. Now, when does it make sense to buy stocks? How can we avoid a lost decade and better gauge if you're heading back to a bull market? Well, we need to see if the conditions for moral hazard is back, if people feel like throwing the dice again, and if the environment is conducive for companies to grow. And that means both a low interest rate and low inflation environment. You need both of them. You need both, not just one. And when we are in a low interest rate and low inflation environment, like back in 2008 to 2021, the S&P grew by over 11%, even though the annual GDP growth of the United States was at best 4% during the same time frame. Now, this just shows how much money is sloshing around the system thanks to low interest rates. Companies get to borrow at dirt cheap rates and they can use it to fuel their growth, and investors can borrow money also at dirt cheap rates to speculate and beat the prices of the stock market up. Because inflation was also so low over the past decade, averaging at only 3 to 4%, people have more cash to invest in, right? The prices of food and rent were still manageable to a certain extent, so people had excess money to speculate in the stock market. And we also have to understand that speculation in the stock market will always be around. It's one of the fastest asset classes to move when the conditions are right, because it's just so convenient to access, right? You can access it on an app, you can just click a button and you're in. In fact, a survey by the Pew Research Center found that over 50% of US households have invested in the stock market, and households have over 40% of their net worth tied up in equities. Now, that is why mainstream media always focuses on the stock market, because everyone is invested in it. And this is why investing is key. We want to be in an arena where the majority of money will flow in when times are good. And that is why I am gradually averaging in during this market crash as well, and buying when people are starting to cry about the end of the world. Because eventually the markets will recover, the disaster zone will clear, and there will come a point in time when the Fed will start lowering rates once inflation is lowered and unemployment goes back up. And this environment could really trigger a decade-long bull run, and you want to be positioned for that. But here's the thing, just having stocks alone isn't enough. Every investor should also hold some gold. Now, billionaire investor Ray Dalio once famously said, "If you don't own gold, you know neither history nor economics," and that is true. True money has always been gold and not just paper abstracts that we are using today. And that is why we have seen the US dollar lose over 97% of its purchasing power over the last 100 years, while gold held its value and actually appreciated over a period of time. Now, Ray Dalio also came out to say cash is trash and equities are trashier, and has a bigger allocation to gold since the start of the year to protect his portfolio, and it's really obvious why. During the majority of market crashes, gold has actually outperformed the S&P and on average has actually gained in value, and we are already seeing it play out today as well. Gold is deflation protection as well as an inflation hedge. Right now, we are seeing the Federal Reserve tighten and hike rates, and that is bearish for almost all assets. But once they U-turn their monetary policy, once they start printing money to lower rates, gold prices could really take off again. And we can see that immediately after the 2008 crisis and the 2020 crash, when the Fed decided to lower rates to near zero and printed up trillions of dollars, gold immediately reacted and shot up in price, accounting for all those excess dollars in the system. Because it isn't really that gold became more valuable, it's just an inanimate yellow metal, right? It was the dollar that rapidly lost value. Now, taking a closer look, we can see that gold actually outperformed the stock market since 2000 and reacted much more violently when the Fed started to print trillions in 2008 and 2020. Now, gold shines especially when we have negative real interest rates, because it doesn't make sense to hold cash or even bonds if inflation is crazy high. And here's the deadly truth. Inflation will continue to persist. Even if it's 2%, 3%, or 4% inflation rate, it is still inflation, and with the US debt over $30 trillion, there is a limit to how high the Fed can raise interest rates, and this is why real rates could really continue to be low or consistently negative. Guys, he has been negative for over 12 years. However, the most critical reason to hold gold, specifically physical gold, is that it's outside of the financial system. The thing about stocks is that it is still within the financial system. It's either in a custodian account of a broker or bank, and anything can go wrong, especially if a really bad economic crisis hits. There are bank bail-in laws that you must know exist that allows financial institutions to really reach into your account and take your money if the government decides not to do a bailout. Now, I'm not saying that it will happen, but it's a possibility that you need to prepare for, and gold is one of the few portable stores of wealth that can accomplish this. Just this ounce of gold alone holds around $1,700 to $1,800 worth of value. You can really store a lot of purchasing power in gold, and it will protect it like what it has been doing for thousands of years. So if you hold both stocks and gold, you'll quickly realize that there's a beautiful relationship between both of them. Remember that the stock market is a representation of the economy, while gold is true hard money itself that has transcended generations and outlasted every civilization. Now, the S&P 500 to gold ratio is one of the most important indicators that help us measure if stocks or gold is overvalued or undervalued. This allows us to make a better decision if it's smarter to load up more on gold or buy more stocks. Now, the average S&P to gold ratio is around 1.5, and we are at 2.08 today, and we are falling fast. And that means today, it will take slightly more than 2 ounces of gold to buy one share of the S&P index. But if you look back in history, we can see that the ratio was 1:1 and even exceeded that multiple times before. Back during the early 70s to the late 80s, and most recently between 2009 and 2012. This meant that 1 ounce of gold could actually buy one or more shares in the S&P 500. And as we navigate through this market crash, this is disturbing news, because if history was to repeat itself, we can see the price of the S&P 500 crash down and meet the price of gold 1:1. And since we are in a massive sell-off, it could mean the S&P crashing below 2,000, and that's a further 30 to 40% decline in stocks from where we are. I'm not saying that it will happen, but it's a definite possibility considering how crazy high PE ratios have gotten over the past decade. There's a good reason why Harry Markowitz, the Nobel Prize economist, said diversification is the only free lunch in investing. There will be times where gold will outshine stocks and other periods where investing in stocks will give you better returns. Since 1980, we can see that stocks have beaten the performance of gold multiple times over, but in the last 22 years, since the start of the money printing era, gold has outperformed the stock market. And while investing in good companies or the index as a whole is a safe strategy for the long term, we also cannot forget the environment that we are in. We are in one of the most irresponsible periods in history where people treat investing like gambling, when the Fed's default reaction to solving a recession is by printing money, and this means that the boom and bust cycles will continue. Assets will get blown up into bubble territory thanks to cheap money and credit, and we have to position ourselves to benefit from this mania. Markets are getting clobbered right now, gold and especially stocks are getting smashed to the ground, but eventually the market will be risk on once again. No one really has a crystal ball that can predict if stocks will outperform gold or vice versa, and that is why I personally hold both. I want to win no matter the situation. So let me know what you think. Do you own both gold and stocks? And most importantly, which do you think will be the best performer in the years to come? Let me know in the comments below. Stay safe, and if you enjoyed today's video, be sure to smash the like button and subscribe as we navigate through these turbulent times. Thank you guys for watching, and I'll see you soon.